Welcome, folks, to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your assets. Don't forget to subscribe, hit that like button, and share these videos with your friends. It's hard to believe that another week has passed by, and this week was much different than last week. This week we did trade up, but we're now pushing down to the lows of last week. Complete reversal. Last week closed on a high, closed above the 10-week moving average. This week closing down toward the lows. There's a subject I want to take on tonight that I think is important, and one of the unintended consequences of the shutdown of the economy. And that is the healthcare system being damaged through the financial health of the hospitals. I have several clients across the country. They help manage 401ks for hospitals. And what they're hearing from many of the trustees is that there are some serious dislocations of capital. They're running out of capital because the hospitals are running, in most cases, between 20 and 30%. Why? Because they stopped all the elective surgeries. In some areas of the country, in the rural areas, these hospitals can be the primary income source for that county. If you recall, they stopped all the elective surgeries because every hospital bed in this country was going to be full with somebody dying of COVID. Didn't happen. They're going to tell us it's because of social distancing. Maybe it was. But what's happening is these hospitals are running out of money. Yet another situation where even the Fed or these idiots in Congress are going to have to try to figure out how to patch that hole. Just another black hole in many that continue to happen. It's very disturbing to me, and I've talked about this for the last 6 weeks when I see these things happening. Fundamentally, the economy is absolutely terrible. I know there's going to be folks that tell me the economy is not the market. You're right. I've talked about the Fed engineering this situation to be a bottom. Sooner or later, we're going to see unemployment spike to levels that it's going to be hard to be thinking about companies making money. As many as 30% of the people are unemployed. On Thursday, we saw the release of jobless claims, another 4.4 billion, about 26.5. Probably see another number around the 4 million level, pushing us up towards 30. We get unemployment next Friday. That's likely to show some pretty ugly numbers, possibly between 12 to 18% unemployment. This has all happened roughly in a month. We'll call it 6 weeks. But this is part of what I keep talking about as we come into that 1st of May, we're going to start to see these numbers unfold. Once again, the economy is still closed and there's not enough activity to perpetuate businesses going forward. Last night I discussed the SBA loans, how they're not actually getting into the economy, and yet they're passing another bill. The facilities which to distribute this money has been very slow, primarily because the SBA itself is inefficient at best. As we end this week, I'm expecting to see market participants continue to take a more cautious stance as we come into the weekend. The market does close lower. We're likely to see some follow through early next week as there's going to be anxiety around the unemployment numbers and other things that start at the 1st of the month. As I've been saying for weeks on end, we still don't know what we're dealing with, but we're about to find out. And what we're about to find out is not pretty. We're not going to have a bull market in stocks with unemployment at 20 to 30%. Just not going to happen. As the weeks and months ahead unfold, this is not going to get better anytime soon. Let's hope we get the economy going soon. Thank you again for watching these videos. I really appreciate the time that you all spend. Let's go and take a look at the technicals and see what they're telling us for Friday. Taking a look at the S&P futures, the overnight action is down about 0.5%, and the pattern that I've been talking about for the past several sessions is starting to unfold. There's a number of things I want to point out. Yesterday I talked about the S&P stalling at these levels. It appears that's exactly what's happening. With today's action, we will see that cross that I've been talking about, which is right here with the 21 and 40 period moving average. The 40 is still declining slightly at 0.17 now. I've been talking about it will flatten out. The 21 is on a trajectory where it's going to keep up. Now what's happening with the 10-period moving average, which is this red line here, is it's rolling over. It's actually turned down. And this is going to be the driving force. It's going to turn down, forcing the markets to drop below all three averages. So ultimately, the 2689 is where the 21-period moving average is right now. Markets are likely to drop below that, which is going to be about another 80 points. And there's still a target that I've been talking about of 2660 to 2525 level. Now I'm going to discuss the intermediate charts in a minute, and there's a much bigger picture unfolding there, which suggests that this market may potentially be making its last gasp at this ABC pattern that I've been talking about. Let's unpack that just a little bit further. So the ABC is this is an A wave up I'm drawing, B down, and then a C up. Now we're getting this little minor A. I discussed this last night. We get a little 2-bar up. Now we should get 3 to 5 down. Should take us down toward these levels I just discussed, somewhere between 2689, 2525 levels. We're going to see this market come back in against these highs right here. This is going to be your top end range. The moving average pattern is going to continue to fall in this crisscross mode. I talked about this probably about 2 weeks ago, that ultimately this is where we would end up. From this standpoint, the expectations are being built from the PPMs, and the PPM1 is decelerating very quickly. PPM2 has broken through its first derivative, which is this green line here. I discussed this last night. It's still down 0.17, but this is the beginning of that pattern where the green line, which is this 40-period moving average here, will start to flatten out. Now, while it's flat, it's also vulnerable to a downside penetration. And the reason why I say we may be in our last gasp, it is possible we could trade down to this 2525 level, and potentially there's a gap on the daily charts around 2300. This could be the move all the way down. As I said in my opening commentary, there's no way we're going to get into a major bull market with 20 and 30% unemployment. It's just not going to happen until we can see if the economy can make this quick turnaround, people can get back to work really quick. We're going to be in big trouble here, folks. The big story is the intermediate pattern that is unfolding. We had this large spike down, virtually straight down in waterfall mode. Now we rebounded back to the 10-period moving average, and the PPM1 is accelerating down, and all three of these indicators down below are all accelerating, telling us that there is some downside. We're going to test the 2663 level, which is the 200-week moving average. Everything continues to suggest that the market will move toward this 200-week moving average, and the potential to go back under it right now is 60%, especially with PPM1 at minus 2.14, which means that the 10-period moving average is dropping at 2.14% per week. The probability of closing above that average remains low, suggesting we will see the market come back to the levels I just mentioned. This downward sequence could end up to be extremely powerful on the downside, as market participants will be quick to remember what's really going on once these markets start to fail. Let's talk about the larger pattern. This here is the A wave. We should get a B wave down, retracing minimum of 2525 with the possibility of going as low as 2300. I don't believe that the market will just take out the lows here. There's not enough structure here to do. My estimate is that we will see the market decline. We'll even see a partial bounce back toward this 200-week moving average, and then it will go down. But there's going to be more work in here, and we're talking about a minimum of at least 3 to 4 more weeks. We should see several weeks on the downside, possibly that unemployment number that's coming out next Friday, and some of the realities of what's going on in the marketplace will continue to plague market participants and affect market sentiment. Make sure that you subscribe, like, and share these videos. Have a great weekend, everyone. I will talk to you on Sunday night.